Podcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. My name is Bobby Rains. I'm here for our once every 3 weeks members-only workshop. This is our standard disclaimer. Nothing you hear today is a solicitation to buy or sell a security. Investors Observer is not a registered investment advisor and cannot dispense individualized investment advice. You can read the rest of that yourself. All right, let's get started here. All right, so we'll start off after this agenda with what's going on in Investors Observer, talk about what's going on in the market, and then the rest of it is content that's driven by you. We got a ton of questions ahead of time. Thank you for those. I put together slides for a lot of them. Some of them I'll write back to you individually. Some of you have already heard back from me about that, but yeah. And then as always, I'm happy to prepare slides for the workshop. You get a much more coherent answer if you submit your question ahead of time. I'm happy to answer things off the cuff, but giving me a few minutes to think about things is usually better, and sometimes a slide is helpful. Just, mention the workshop. A lot of people just reply to the invite and say, hey, talk about this in the workshop, and that is a totally okay way to do it. All right, so before we move on, we'll talk about what's going on in Investors Observer. We have some exciting things that we're working on in the technology department. Some of you may be receiving invitations to join a beta test program before the end of the month. So be on the lookout for that. And then we hope to roll it out to everybody fairly soon, depending on how testing works, which is how all these technology things tend to go. But we're excited about it. We hope all of you will like it also. All right, let's talk about the stock market. 1 year of daily candles. I don't know exactly where we closed today. This was sometime between 3 and 4. I didn't actually get the close in my chart here because it happened about the time I started talking to you. But yeah, we've sort of topped out at this level twice now, which is not too far from some levels where we had some support last summer. These were sort of, we'll call them trade war sort of declines here. So we'd like to break through that. Obviously, we'll see if we can pull it off. We're still at not really anywhere for the past 12 months. Year to date down, obviously, but yeah, over the last 12 months, we're a little below break even. But yeah, it's not great. And we'll talk a little bit about how that is a little bit deceiving in a later slide. All right, so these slides are very full today because a lot is happening. Uncertainty is everywhere. Again, right, like I didn't even change some of this. No one knows how long this is going to last. That remains true. And you're starting to get some very different estimates. Like if you look at politicians and things like that versus what businesses or schools are planning for. Google and Facebook have said we're, not going to require people to be back in the office next year or until next year. Twitter said, that's a business decision. Twitter said we may never require people to come back. People are being productive at home. So that's a different deal. But it is interesting that businesses seem to be planning to be on a not fully staffed office sort of environment much longer than you would think if you listen to just what politicians are saying. Schools are another very important piece of this picture, right? A lot of people can't go back to work if schools aren't open or daycare centers aren't open, or right, if they have nothing to do with their kids, it's very difficult to go back to work. And then the other thing to think about is how many parents are willing to send their kids back to school under the current conditions. And then also, it turns out that, kids are terrible at social distancing. And so once you send your kids back to school, now you might as well go visit everybody in your kid's class at home for a couple hours, because if anybody your kid's school has been exposed to this, the kids have been exposed to it, and now your kid's been exposed to it, and now you've been exposed to it. So that seems, yeah, that's that seems like an interesting. Hang on. Can't tell. It says my audio has been lost. Oh, okay. All right. Sorry about that. I'm not sure exactly what happened. My audio seems to have dropped. Okay. Awesome. Thank you, David. Okay. Excellent. Okay. So, yeah, school reopening seems very important for the rest of the economy, and I don't really know how they're going to figure that out, but hopefully somebody smarter than me will. And yeah, even as you do reopen, you have to think about, what does reopening mean? It's not a particularly popular idea right now. Early returns from places that have reopened don't show a big surge in economic activity. And then, yeah, for things to fully get back to quote unquote normal, you have to think, what does it take for you to want to sit next to a stranger in a movie theater, or share an armrest with somebody on an airplane? That's what getting back to the pre-crisis normal looks like in any case. And I feel like that's probably a ways away. I think something more likely to happen is we have a new normal that looks a lot less efficient than the normal that we're used to, right? Like, I mean, retail and airlines, right? Those things optimize on dollar per square foot, or airlines, it's, trying to maximize dollars per seat mile. And you can't do that and maintain any kind of social distancing. And I don't think packing people together is a good idea or going to make your potential customers very happy. And then another thing we've seen here is that the sort of just-in-time single-source supply chains that made things very efficient have proven to be pretty vulnerable, right? I mean, you get a virus outbreak halfway around the world, and if the one city that makes the part for your thing is in that city, and that city gets shut down and nobody can go to work, now you can't make your thing anymore, right? That was a problem that we talked about back in January when this was still mostly in China, was right, like Apple and some other places were having trouble getting parts to make things. We talked about supply shocks. Well, now it's here and we're dealing with demand shocks. But as we try to open back up, people might start to rethink some of those supply chains. The hyper efficient businesses that do all that have proven to be some of sort of the least robust. Amazon is sort of an exception, but even then, Amazon's really struggling. They're not keeping up. Things aren't getting delivered with the frequency they were. They're just having trouble filling orders. They're having to spend extra money on worker safety. I mean, they're making a lot of, they're making a ton of sales, but they're not really making any money. As they said, on their earnings, was it 2 weeks ago, I think. Yeah. All right, and then earnings were down. Expected earnings are much less available than they were. Tons and tons of companies just aren't providing guidance for the rest of the year. But where they are available, they're down sharply from January. We got CPI numbers yesterday, which is kind of interesting. They showed a decline in prices on the headline. Down almost down almost 1% from March. That's not an annualized number, that's month over month. But internally, there was some other stuff going on, right? Food at home rose 2.6%, again, month over month, which is a massive increase. Overall, food rose 1.5%. So what you look at here is, you have a sort of thing where everything is on sale except for the things that people are reliably buying, which is basically food. And there you see inflation because the sort of mix of where people are buying things has changed a lot, and that has put stress on those super efficient supply chains, right? We live in a world where a farmer knows where his crops are going, sometimes before they're planted, before the chickens are hatched, whatever it is, he knows where those things are going, and it's a sort of end-to-end supply chain where everything is sort of spoken for. And what that means is if something in the middle of that chain breaks, well, now the farmer can't find somewhere else to sell his crops. The restaurant at the other end maybe has a hard time getting supplies. All that stuff gets real difficult. And so the things that there is consistent demand for, food in particular, the price goes up because there are some shortages there. Meanwhile, everything else is on sale. And so I don't think that's particularly a sign of any kind of long-term trend, either on the inflation side or the deflation side. I think it's just a weird number because a lot of things are broken right now. And yeah, as things start to be open, we will get some growth for things due to pin-up demand from delayed purchases. Some of that stuff won't come back though, right? Like you're not going to go eat twice as many restaurant meals or go to twice as many movies or go on twice as many vacations when things reopen. So some of that spending won't be back up. And airlines and cruises in particular, those things are going to take years to come back. Delta said it a couple weeks ago. I think their CEO kind of got criticized for that, but I think the CEO of Boeing said this morning maybe he expects a major airline to go bankrupt. He didn't name one, but yeah, that's sort of where we are right now. And so yeah, those things are going to take years to get back to some kind of something that resembles the pre-crisis level. And so you're probably going to end up with either a bunch of unprofitable companies sort of struggling along for a very long time, which it'd be interesting to see how they find themselves doing that. Or you're going to see just big cutbacks in the supply of seats. And then, as we move, further into this, additional drag comes from states and localities. Those, places that are funded by, especially the ones that are funded by like sales tax and where they have a lot of tourism dollars. They have restaurant taxes and lodging taxes and things like that. If nobody's coming to visit and nobody's eating out at restaurants, you're not collecting those taxes. And unlike the federal government, state and local governments can't run fiscal deficits. So that means that jobs for anybody who works at teachers, firefighters, cops, all those things, those jobs are potentially on the line to some degree because those budgets have to balance at the end of the fiscal year, and if there's a big drop in revenue, there has to be a big drop in spending unless somebody comes in to fill the gap. All right, so let's talk about the output gap. So this is a thing that we're going to talk about. As things recover, there's an output gap. So the output gap is basically the difference between an economy's output and its potential output or capacity. So if you consider the white line here to be sort of an economy's trajectory, okay, so let's say this is our economy and we're on this white line, and then the yellow line is an event that happens. Okay, well now what happens is we have this event that happened, and so here is our potential capacity, still the white line here, this trend going upwards is think of that as a GDP growth rate. Well, now we had a recession, so now our actual output is down here. Okay, so so you can resume things even at the same trajectory and you haven't actually recovered. So output gaps can be very hard to measure in real time, right? Like in the current crisis, we know there's an output gap, right? Tons of people just got sent home from work. We know the economy could be producing more. A lot of times an output gap is a thing that it's there, but you're not sure how big it is. And then after the financial crisis, there was a ton of talk about whether there was an output gap. People talked about a skills gap. But I think the amount of time it took back to get back to full employment, and even in the fact that we went past full employment, which people had considered at like 5% or 4% or 4.5%, and we got down to like 3.5%, and there was no real appreciable rise in wages, suggests that even at full employment, we still had an output gap years after the financial crisis. I'm not entirely certain it was ever fully closed. And yeah, obviously currently we have a ton of idle workers. We're running at much less than capacity. And then yeah, as you try to recover, getting back to sort of this level of GDP growth just puts you on a parallel trajectory. It doesn't actually get you back to you never actually catch up that way. So what you need to do is actually run hot for a while. That's why people heard the Fed talk about a symmetrical inflation target where they're willing to overshoot the target and let things run hot for a while to try to close an output gap. That's why you would do that, because it's not enough to get back to the previous trajectory. You have to overcome that gap. All right, and speaking of the Fed, Jay Powell gave a pretty interesting speech this morning. I mean, I'm not the biggest Fed scholar, but I've read a fair amount of correspondence from the Federal Reserve, and listened to a few speeches. I listened to a lot of Ben Bernanke back in the day, and a lot of Janet Yellen, even some Alan Greenspan. But yeah, just the tone of it was striking to me. Just it was sort of surprisingly empathetic and human, whereas those speeches are usually very, very technocratic. I think some of that probably has to do with sort of the nature of the crisis we're facing. In the sense of it's not a technical thing, right? Like Powell isn't getting up there trying to explain how we're going to unfreeze credit markets, right? Like it's a very human crisis that's causing an economic crisis, as opposed to sort of the other way around. But yeah, some things I thought were interesting were this is apparently from a bigger survey that's going to be released tomorrow, but 40% of households making less than $40,000 a year had a job loss from February to March, which is just an astounding number. And that really sort of highlights one of the weird things that came out of the jobs report last Friday, was that wages went up, right? So millions and millions of people lost their jobs and wages went up. And functionally, that's because the people who are being most hurt by this are the people at the bottom of the wage scale. And so, yeah, the way averages work is if you take off the bottom, the average goes up. And yeah, a lot of the speech seemed to be very much sort of an argument against the concept of moral hazard. He, said a couple times this wasn't because of a bubble or any sort of speculative thing like that had to be deflated. It was sort of an interesting thing for the Fed to say. Moral hazard is the idea that if you bail out actors who took outsized risks in a bubble, it creates incentives to do that again. And Powell seemed to be almost explicitly saying, this is not a case of moral hazard. This is actually a problem that is beyond the people who are being hurt by its control, and not anything that should be put at their feet. And yeah, he noted it's the biggest, fastest downturn on record, and also the largest fiscal response on record. He said, 2.9 trillion authorized by Congress so far, or about 14% of domestic GDP. And then I thought this bit was interesting. Economic forecasts are uncertain in the best of times, and today the virus raises a new set of questions. How quickly and sustainably will it be brought under control? Can new outbreaks be avoided? Is social distancing lapse? How long will it take for confidence to return and normal spending to resume? What will be the scope and timing of therapies, testing, and a vaccine? And then, yeah, since the answer to all of those are unknowable, policies will need to be ready to address a wide range of possible outcomes. All right, and then, yeah, just a couple more pieces that I pulled out. Household and business insolvencies can weigh on growth for years, right? Like if your business goes out of business, the sort of relationships between people and businesses, whether it's as employee or whether it's as customer to business or business to employee, all those relationships take time to form. And so if you can keep them intact by keeping businesses sort of, afloat and solvent, the recovery is a lot faster. Whereas if you lose a lot of businesses now, right, you can't just show up and start a business. You have to go hire people and figure out suppliers, do all of those things. The recovery is just a lot slower because of those sort of logistical and relationship problems that have to be overcome. And then again, yeah, he kind of alludes to a little bit of, right, destroy the life's work and family legacy. Again, this is just really interesting language coming from the Fed in terms of the sort of empathy and humanness involved. And yeah, small businesses are most of the job creators in this country. So trying to keep them afloat is going to be a big deal. And then the last, yeah, his conclusion was also sort of interesting. He said, we should do everything we can to avoid these outcomes that require additional policy measures. And then he highlighted that, the Fed has lending powers and not spending powers. The Fed can make loans. The Fed can't just make money and push it out, though. Right? The recovery may take some time, and it turned out that if it takes too long, loans don't fix the problem, right? Liquidity problems turn into solvency problems. My liquidity problem is I can't pay this bill. Solvency problem is I have a bunch of bills I can't pay and no money coming in, right? And then, yeah, the conclusion of the speech here was additional fiscal support could be costly, but worth it if it avoids long-term economic damage. He's, without explicitly saying Congress should spend more, that's basically what he's saying here, is that, the recession will be less long if Congress spends more and, makes it a real point to try to get us out of this as quickly as possible. All right, so that is that. Let's see here. Let me glance at the questions. As always, if you have questions, put them in the box. I will get to them sort of as it, either if it's relevant or as it becomes relevant. All right, so here's a Fed-related question from Kevork. He said, what do I think of Powell not considering negative interest rates? It's an interesting question. I've read a lot of stuff that suggests that negative interest rates may not work in the U.S. It works in the European Union and it works in Japan, but they have sort of a different monetary plumbing system, if you will, than we do. I don't know if it will work or not necessarily. I think the Fed has plenty of tools that they can use, to sort of lengthen the money supply. I know that negative interest rates is one, but I don't know that it's necessarily better or worse than some other things that they could do. Yes, this is being recorded. We will make the recording available probably tomorrow. We'll send an email to everybody who attended and post it on the website as well. All right, so let's get into the questions. Given the Fed's gloomy report this morning, are there any areas of the market that have you bullish? If one is loaded up on tech and pharma stocks, might one consider selling or holding? Honestly, the answer to this question, like so many investing questions, really depends on your time frame. Tech and biotech have held up well and will probably continue some relative outperformance, which I would caution is not the same as gains, right? Going down less is not the same as, going up more. So I think that's sort of an interesting, it does depend on your time frame. I mean, for the next 6 months, the next 3 months, who knows, right? I think the shorter your time frame, generally, the harder it is to predict these sorts of things. Longer term, I think one interesting trend that I'm seeing is sort of a rise of direct-to-consumer retail. If you're making things and trying to sell them and you can avoid having to deal with, physical stores or middlemen like Amazon, you know, a lot of new things are coming online that may make it worth it, like a PepsiCo. PepsiCo has apparently owned the domain snacks.com since the 90s. And they just actually put up a snacks.com website like this week. And yeah, you can go buy Flamin' Hot Cheetos directly from Pepsi online now, which you could never do before. That sort of thing is an interesting trend to me. I don't know that that will be material to Pepsi's business, but I also look at things like the amount of, you know, what seem like relatively small businesses who are able to reach out to customers through things like you know, Instagram advertising. Some of that's enabled by Shopify, some of that's enabled by other tools. It's a little hard to tell what the underlying technology is sometimes, but yeah, like social media for all of its ills, one of the things it does do is it makes micro-targeting an audience on a national level possible, which means if you want to reach everybody in the US who you think might be interested in your product, you don't have to buy a national television campaign, which is incredibly expensive. You can buy a few ads on social media, which is relatively cheap if you're trying to reach a relatively small number of people, but they're spread out. And that's the thing that's small, especially, you know, physical, you know, people making physical things had a really hard time doing is scaling nationally, but the, you know, the shipping infrastructure and things like that are there to a large degree. And I think that's a really interesting thing to me. So that would be another thing that I would look at in addition to sort of generic tech and pharma, which have been obviously held up well recently. All right, so Vincent said, do I think we'll have inflation or deflation, and at what rate? And do the banks do well in inflation or deflation, and why? So at what rate is definitely not a thing that I can answer. You know, as I said earlier, the inflation numbers are noisy. Some things are going up while some other things are going down. And there's a weird thing with inflation, especially in the short term, right? So like that last month report, you have supply and demand balances versus the changing value of the dollar, which, you know, inflation or deflation is supposed to be at the changing value of a currency, whereas, you know, temporary imbalances in supply and demand are not actually the same as inflation. So that's, you know, it's really hard to tell what we have right now without looking at some sort of longer trend. Inflation would be sort of surprising anytime soon, given that recent recessions and expansions have been characterized by pretty low inflation. That's been a big question, is that, you know, the actual measured inflation has significantly and consistently undershot people's expectations for at least the last decade, if not longer. Deflation isn't impossible, but probably not likely either, just because the Fed seems to be pretty willing to keep the money spigot open as much as possible. And yeah, just pumping money into a thing. You know, there is an article on the website you can read now about the concept of a liquidity trap. It's on, if you go to the news page, it's in the featured section. You know, it's not impossible, but it doesn't seem particularly likely either. I think sort of kind of neither is probably the more likely outcome. And then banks, there's a lot more to consider than inflation or deflation in terms of where do banks make money. Generally, banks make money in a growing economy with an upward sloping yield curve. Banks make a lot of money, although it's less than it used to be, on what's called net interest margin. So if you think about what a bank does, is they borrow money from you, your deposit is a loan to the bank, and then they make loans to other people. And so the loan that you make to the bank is typically very short term. It's, you know, either basically overnight or some sort of timed deposit, they call it, like you know, CDs, things like that. Those things typically are much shorter than the duration of you know, the loans that banks are making. So, you know, having higher long-term rates than short-term rates is really a sort of thing where banks make money, which is, that's a growing economy. And then also, yeah, when banks are doing a lot of business, they also charge fees. And so when people are coming to the bank asking for things a lot, saying, hey, bank, I'd like to do some business, banks make money from that too. So when banks make money is a growing economy with an upward sloping yield curve. It has less to do with the specifics of inflation or deflation. All right. All right, so Garth wanted to walk through the option screener functions and talk about some of the trades and how they work. So let me pull up a web browser here. All right, so we'll go, let's just go look at Microsoft at Garth's suggestion. All right, so we have there are potentially 7 option strategies that we use here at Investors Observer. Covered calls, short puts, bullish and bearish diagonals, bullish and bearish verticals, and iron condors. So the covered call, essentially, right, we have these columns here: bought leg price, sold leg price. Let's stick with those for now. So the bought leg is essentially what you're going to buy for this particular trade, right? So for a covered call, you're going to buy 100 shares of the stock, and the sold leg is what you're going to sell. So you're going to sell an option, in this case, the May 22 expiring 182.50 call. And we have prices for these individually. But really what you want is, in this case, it's probably easier to do it here under details. Well, that's not ideal. Okay, so the amount at risk here is also the same as, say, our net debit. So this number will be 182.51 minus 328, should give you something awfully close to 179.23. So the idea is you sell the one leg, you buy the other leg, and the net price is this amount at risk here. And then the other numbers I think are pretty self-explanatory. Short put, all you're doing is selling a put. That's what that is. It's the May 22 180. Diagonals, the diagonals on the bullish side are a lot like a covered call, except instead of buying the stock, we're going to buy a long-dated, deep in the money call option. And what that does is it lowers the amount we have invested in the trade. Right, 70 bucks instead of 180 bucks. It also, in most cases, because there is some leverage involved there, raises the return rate on a percentage basis. You can see that the actual cash profit is lower between here and here, 207 versus 327, but the percent return is higher because making it 2 option legs is essentially adds some leverage to the trade, so it gets a little higher. The bearish diagonal is the same concept, except sort of upside down and using puts. So you're going to buy a deep in the money put option and sell a near the money put option. Again, you're hoping that both legs stay in the money and you can close the trade for roughly the strike width there. And the verticals are a little bit different because these are credit spreads. So whereas covered call, bullish diagonal, bearish diagonal, you have to pay to open the trade. In this case, you get paid to open the trade. So here we're going to sell an out of the money put. The sold leg here's the 180, and then we're going to buy one that's further out of the money for a net credit. So it's sell this and buy this and actually collect $1.36 up front. If everything goes as hoped, you keep the $1.36, the options expire worthless, and you're good to go. And then the bearish vertical is, again, the same basic concept, but upside down. It's sell a call, buy a call that's further out of the money, collect a credit for that, and hope the stock stays below the strike price. All right, so those are those. Let's see here. I had a couple more options questions. Raphael said, how do verticals settle after expiration if both legs end up in the money? Do I need to exercise the long, or is it done automatically? Automatic exercise is pretty standard at all the brokerages. Yeah, I don't know exactly where your account is, so I can't say with 100% certainty, but typically automatic exercise happens at 1 or 2 cents in the money. at most of the major brokerages in any case, so that's not really a problem. If both legs are in the money, should be one is exercised and the other is assigned. You know, if you get pegged and the stock closes at the strike price, that may be a thing you need to figure out how to deal with exactly. But you may not get automatic exercise there, but in most other cases you should. Now, can I illustrate pin risk? Pin risk is really just the risk that an option suddenly goes in the money at expiration, right? So it's out of the money, it's out of the money, it's out of the money, and then all of a sudden at 3:50 on Friday, it's in the money and you don't have time to close the trade. In that case, you get assigned on the trade and you end up basically having to hold the underlying or hold short the underlying until the market reopens, which is usually over the weekend or overnight, depending on which options you're trading. The solution is really just close the option trade if it looks close. We've certainly done that before. I'm not going to say I've never been pinned on something on a vertical spread before, but it's pretty unlikely because if it looks close, I'll sell it for close it Friday morning or Thursday for something close to close to the full profit, and then you don't get the full profit, but then you don't spend Friday afternoon worrying about the stock ticking up by a nickel. Oh, I already did that one. All right, what is the best way to use to identify option trades using the screener? This really depends on what you're looking for, but one thing I would highlight, and we'll go back to the website in a second, is that the keys are about the option trade and the rating is about the anticipated direction of the stock. Let's go back here, options screener. Let's start over because I'm not sure exactly where I was. All right, so we'll just do covered calls here. The screener has a ton of stuff, right? There's the 7 different option strategies, obviously, and then inside of there you can sort for things. If you don't want anything that's super long, you can pick a maximum expiration date. You can also pick a minimum expiration date. Let's say we don't want anything less than let's say 15% on an annualized basis. And then risk management, right? Covered calls can get expensive. You got to buy 100 shares of the stock. So we'll say nothing more than $100. And then, okay, so overall score and key rating are where it gets interesting. So key rating is our rating of the relative safety of the option trade. So we don't consider what we think about the stock at all when when doing the key rating. What we're really looking at there is how much downside protection does the trade have, right? How far in the money is the option? Because if you can write an option that's already in the money, you're much more likely to make the target return there on that covered call than you are if you're writing one that's out of the money, because now you need the stock to move. Right? If I write a covered call that's 3.5% in the money, what I need to make the full profit there is for the stock to not go down by 3%. If I write one that's 3% out of the money, now I need the stock to move by 3%. And so betting on something not happening is a more likely outcome than betting on something happening, if that makes sense. So that's the keys, right? Another thing we look at is the strike widths, right? So if you had a covered call and something went wrong with it, or you wanted to adjust the trade in some way, you're going to want to have weekly options. You're going to want to have strikes that are very close together, right? You want those $1 or 50-cent strikes and not the $5 strikes. Okay, so all of that are the things that go into the key rating. Our anticipated direction of the stock is, in the overall score, right? So a high overall score is a much more bullish score than a lower score. So even though, let's see, ADS here and Amerisource, Bergen up here, both have 5 keys. That's about the options, right? These trades have, right, the options are pretty liquid. They got strikes that are close together. The trades aren't very long. They're in the money. ABC and ADS both have those things in common. Where they differ is Alliance Data Systems has a 38 in terms of overall score, and ABC has a 78. So, if I had to pick one, I'd take ABC every time because the 5 is nice, right? If I had two 78s, I would take a 5 over a 3. But if I'm looking at at a 78 versus a 36 or 38, and I'm making a trade that has a bullish bias, which the covered call does, you take the higher overall score there. The key rating is not about the direction of the stock. The key rating is about how defensible the option position is. All right, so David said, even though the market has been in a strong rebound, we're not making portfolio trades. The brief downturn at market close yesterday might have been a response to COVID conditions or COVID cautions. He's expecting more declines, not sure how to trade options to capture the uptrend amid untimed risk. This is the thing that everybody has been trying to figure out. I saw somewhere earlier, let me pull in this other question and we'll try to knock out a couple things at once here. So somebody earlier said jobs report and the market direction do not match. Can I please comment? So this is a thing that's been bugging me too. We wrote earlier this week in one of our market commentaries. You can find it right here if you go to the news page. It's over here. I pulled out this quote. I actually saw it on Twitter, but it was a quote from a Goldman Sachs note. The S&P is 13% below the all-time high. The median stock is 23% below the all-time high. So Facebook, Apple, Amazon, Microsoft, Google have all posted positive year-to-date returns. The S&P is down 9%. What this means is it's a rally in a very small number of stocks, right? And yeah, Facebook, Apple, Amazon, Microsoft, Google, those are all big names. They're all technology. That seems to me like people hunting for safety. And there's some, right, Shopify has been a performer. I think Salesforce has done pretty well. Netflix has done okay. And you can make a case for all of those sort of in a vacuum. But cloud services companies selling services to other cloud services companies doesn't seem like an actual functioning economy to me. This is why we've held off on portfolio trades. I also have noticed this thing. The disconnect in between economic data and the broader economy. Let me actually pull up because I don't remember the stats off the top of my head. But yeah, so we looked at some sector ETFs earlier this week when we were writing this. And so yeah, the number of things that's up is pretty small. Right, technology, communication services, which guess what is where Facebook and Alphabet both live, is up 33% year to date. That sector. And then biotech is up. That's probably not super surprising. And then everything else is down. So really the market looks like it's doing better than it actually is, because these are basically 5 of the biggest stocks in the world. And so they are, the market looks really good, but it's not. It's not a. This is not a case of a rising tide lifting all boats, is I think what I'm trying to say. There's a few big names that are doing really well, and some other smaller names that have also done pretty well, and there's a whole lot of stuff that's really sort of struggling, and trying to figure out how long that lasts and if it can last is a sort of an interesting question. All right, so let's look through some of the other questions people have submitted. All right, so we got a question from Dinakar who said, has the services trading playbook changed or evolved since the critical economic crisis? Have our changes from rules for trading specific strategies? I mean, what we're doing has certainly changed. As mentioned earlier, we haven't made a lot of portfolio trades. Some of that stuff we're just not doing. Some of the other trades, we're further in the money, which we can do and make the same premiums because volatility has been high. So we're doing a few things like that. I feel like I've talked a lot in previous workshops about not having a lot of hard and fast trading rules. Conditions do change. If there were hard and fast trading rules that worked in every situation, then at some point everybody would use those rules and then everybody would make the same trade. And guess what? If everybody's trying to make the same trade, then everybody's buying at the same time and nobody's selling and the market breaks. So hard and fast trading rules I don't really have a lot of, other than, I could tell you my one rule is try to be flexible, but that's not really a rule. So yeah, we have certainly changed what we're doing. It seems more prudent at this juncture to kind of sit and wait until we feel like we have a handle on something than to just, I mean, I think the strategy that maybe we could have done in retrospect is, just trade Apple and Microsoft. But yeah, finding good trades in retrospect is pretty easy. It turns out. It's finding them when you don't actually know the outcome that gets a lot harder. So let's see. We have, can I use InvestorsObserver for penny stocks? There are a lot of penny stocks on InvestorsObserver. Our system does not work if this stock hasn't traded for the previous 20 trading days. But really, if your stock can't be bothered to trade every day, I have some questions about why you're buying it. It's pretty liquid, et cetera, et cetera. It's not a stock that tons of people are interested in if it doesn't trade every day. So I'm not sure we don't rate those, and that's because they're either unrateable or not worth rating generally. All right, so Christopher says, when things open up and people start traveling, do I see energy and oil stocks having an upside? Or are they in the same boat as airlines? That's a super interesting question. What's interesting about that is airlines are a major user of oil. On a certain level, I don't really anticipate oil demand getting back to pre-crisis levels until the rest of the transportation sector gets back to those levels. I certainly think there's probably some upside, but I don't know when and I don't know who. Every oil producer, especially the U.S. guys, the onshore guys, has a different break even depending on where they are. And there's transportation costs and all sorts of things like that. And yeah, you really would have to study into like what people's break evens are and what their debt was and can they refinance it. I've been seeing rumors that Chesapeake is going to go bankrupt for like 3 weeks now. And I know Oxy has had some struggles. I think they sold some bonds or were talking about selling some bonds. In any case, they certainly have some upside. So the interesting thing about valuing an oil company is, as opposed to an airline, is airlines and tech stocks and things like that are really valued based on, sort of all businesses on some level are valued based on what profits will they make in the future, right? The net present value of future cash flows is the basis for all of finance. But oil companies, right, own an asset, and that asset is oil that is in the ground. And so when you're trying to value an oil company, it's not just how profitable will this company be in the future that you have to try to figure out. Right? You can't just do some math about like, well, it makes a nickel to it costs a nickel to make a widget. You can sell that for 7 cents. You make this. You can sell it for 10 cents. You make this. You can make get production down to 3 cents and keep selling it for the same price, right? Like that's how you value a lot of businesses. But oil companies owned a bunch of oil that's in the ground, and so how much oil can they pump, and at what price can they sell it, and then how many years in the future will they be still pumping oil at that rate, or at a given rate and a given price, gets to be real complicated. So yeah, when the price of oil goes down, the reason oil companies get hit so hard is, especially something like this, or you've looked at like fracking coming online and things like that, they are very asset heavy companies, and the value of their assets just went way down. Whereas people talk about companies being asset light, right? Like Uber owns practically nothing and has practically no employees. It's a very asset light sort of company, right? Like if you sold Uber for parts, you don't have very many parts. You got a few office chairs and some computer code. Whereas an oil company, if you sell it for parts, what you end up owning is a whole lot of oil that's in the ground somewhere. And so that's what makes those companies hard to value. There probably is some value to be found there, but in terms of, yeah, you get into questions of like time frame and then having to understand balance sheets on a level that I can't really get into in a workshop like this. All right, let's see here. Investors Observer doesn't deal in Bitcoin. Greta, it's not a thing we cover. I'm not particularly high on it, but we'll just stick to Investors Observer doesn't cover it, as opposed to getting into a longer discussion of why. So Ken said he's looking into why Investors Observer would be a platform for trading ideas, specifically around options. We do options. Options is where we got started. It's a lot of spread trading. If you're looking to buy calls, we don't offer that specifically at the current time. But covered calls, diagonal spreads, vertical spreads, we got all of that, and we're looking to add more strategies in the future. So we may get to that at some point, but we don't have it currently. All right, hotels and shopping center stocks, like Simon. Yeah, I mean, shopping centers are, especially the big malls, right? Those stores were dying anyway. JCPenney, well, I guess they caught a lifeline today. But JCPenney, Macy's, I guess Sears is gone now. Yeah, I don't know that being a landlord to a bunch of those companies was a good business before. I certainly think it's probably not a good business now. And then I think, again, kind of like the oil companies, you really have to dig into the shopping center stocks and look at who their tenants are and the geographies and some things like that. If you got a ton of restaurants, I don't know. If you got a bunch of grocery stores, you're probably doing okay. So that's the kind of thing I would look at there. And yeah, the hotels, the hotels are probably closer to the airlines in terms of, the ones that can stay solvent will probably get back to business at a certain point. But which ones can stay solvent is a different question. All right, so Tim has asked for a short version of why not a fan of Bitcoin. Generally, Tim, it seems like a question or an answer without a question. Like I'm not sure what problem it solves. Typically, products or services solve some sort of problem. Right? As a, I don't. Yeah, I don't. I guess I could transact in Bitcoin in some specific ways on the internet, but I don't get paid in Bitcoin, right? My rent's not in Bitcoin. Nothing I do is denominated in Bitcoin. So now all I've really done is taken on currency risk, except it's not really a currency because there's no inherent demand for it because at any significant level, no one is getting paid in Bitcoin and no one's obligations are in Bitcoin. So there's no one is being forced to transact in it. And so I just don't understand why. I don't understand why it should be a thing. And I'm not a huge fan of gold for similar reasons. It certainly works as an inflation hedge, but I feel like the case where gold actually becomes useful is as a hedge against inflation, and not so much some sort of grand economic collapse where the dollar becomes absolutely worthless. If the world economy collapses to the point where dollars are no longer worth anything, don't think gold is good for much either, except for maybe hitting somebody over the head and trying to take what their food is, right? Like you're talking about a real breakdown of society at that point. And if you can explain to me a situation where there's a real breakdown of society and also the electric grid is working and all the communications and infrastructure is working, which is what's required for Bitcoin to work, maybe we could talk about it being a catastrophe hedge, but I'm not seeing it. It seems like all you're doing is adding some sort of, adding some volatility and a sort of weird pseudo, but not really currency risk to a portfolio with buying Bitcoin. Yeah. Anyway, all right. I think that's about it. It seems like the flow of questions has stopped coming in. As I mentioned before, this is being recorded. We'll send out a recording tomorrow. It looks like, let's see here. Yes, thank you, Kavork. June 3rd, it will be our next workshop. Probably about the same time of day. We'll send out invitations ahead of time. And yeah, I hope to talk to you all then. If you have any questions between now and then, you're certainly very welcome to give us a call. There's a help button on the website. Let's see here. Website. You can hit this help button. That sends an email to our support team. We get back to most things pretty quickly. So yeah, that's another good way to get in touch with us if you don't want to pick up the phone or it's not normal business hours. But yeah, thank you all for coming, and we will talk to you next time, if not before.